Welcome to our channel where we delve into the world of finance and investment. Today's topic is Bitcoin the best hedge against inflation? Now you may ask, why is this topic important? Well, in a world where the value of traditional currency is constantly fluctuating, having a hedge against such volatility becomes crucial. And that's where Bitcoin comes in. Bitcoin, a decentralized digital currency, has been making waves in the financial world since its inception in 2009. Some see it as a speculative bubble, while others view it as the future of money. But can it really serve as a hedge against inflation, protecting your wealth from the eroding effects of rising prices? In this video we'll explore this concept, dissecting the pros and cons and looking at how Bitcoin compares to traditional hedges like gold. So sit back and prepare to discover if Bitcoin could be your secret weapon against rising prices. If you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us, and remember to comment and share. First, we need to understand what inflation is. In the simplest terms, inflation is the rate at which the general level of prices for goods and services is rising, while subsequently, the purchasing power of currency is falling. It's like an invisible tax that chips away at the value of every dollar in your pocket. Now imagine you're holding a $100 bill. Today it can buy you a nice dinner for two. But fast forward a year or two, and that same $100 bill might only afford you a quick lunch. That's inflation at work. Inflation is a natural part of a healthy economy. It's often a sign that an economy is growing. When there's inflation, businesses are generally selling more goods and services, which might indicate that consumers are spending more, and that can lead to companies hiring more workers, reducing unemployment. But like most things in life, too much of it can be a problem. High inflation can wreak havoc on an economy. It can reduce the purchasing power of money, meaning your hard-earned dollars buy less and less over time. This is particularly problematic for people on fixed incomes, like retirees, because their income doesn't increase even though the cost of living does. For investors, inflation is a silent enemy. It can erode the real value of cash and the returns on investments. If the return on an investment is lower than the rate of inflation, then in real terms, that investment is actually losing value. That's why savvy investors are always on the lookout for investments that can outpace inflation. So, how does inflation impact the economy? Well, it's a bit like a game of dominoes. As prices rise, businesses may need to pay more for raw materials and wages. These costs are often passed on to consumers in the form of higher prices. This can lead to a vicious cycle of rising prices and falling purchasing power. Inflation can erode your savings and investments over time, which is why investors look for ways to hedge against it. Now that we've covered inflation, let's move on to Bitcoin. In the simplest of terms, Bitcoin is a digital currency, but it's so much more than just that. It's a decentralized form of money, meaning it's not controlled by any central authority like a government or financial institution. It was invented in 2008 by an anonymous person, or perhaps a group of people who used the pseudonym Satoshi Nakamoto. Bitcoin operates on a technology called blockchain, a public ledger containing all transaction data from anyone who uses Bitcoin. Transactions are added to blocks, or the links of code that make up the chain, and each transaction must be recorded on a block. But here's the kicker. These transactions are verified by other Bitcoin users, not by a centralized authority. This makes the whole system extremely transparent and secure. Now, why has Bitcoin gained popularity? There are a few reasons. First, it offers a level of anonymity. While all transactions are transparent and traceable, the personal data of the parties involved remains hidden. Second, Bitcoin has a cap of 21 million coins, meaning its supply is finite, unlike traditional currencies. This scarcity has made it particularly attractive to investors. However, Bitcoin is not without its risks. Its value can be extremely volatile. In fact, it's not uncommon for the price of a single Bitcoin to fluctuate dramatically within a short span of time. This volatility can lead to significant financial loss for investors who are not careful, but it's not all doom and gloom. Many investors are drawn to Bitcoin because of its potential for high returns. The value of Bitcoin has skyrocketed from a few cents to tens of thousands of dollars in just over a decade. Despite its volatility, it has outperformed many traditional investments over the past several years. Despite its volatility, some investors see Bitcoin as a potential hedge against inflation. But why is that? let's dive into the heart of our discussion. Is Bitcoin a good hedge against inflation? To answer this question, we first need to understand why some investors view Bitcoin as a potential hedge. The key lies in Bitcoin's unique properties that make it fundamentally different from traditional fiat currencies. Firstly, Bitcoin has a limited supply. There will only ever be 21 million Bitcoins in existence. This scarcity is hard-coded into the Bitcoin network itself. Unlike fiat currencies, which can be printed at will by central banks, the supply of Bitcoin is predictably decreasing over time. This makes it a deflationary asset by nature, and some investors believe this could protect them against the inflationary pressures that can erode the value of traditional currencies. Secondly, Bitcoin is independent of any government or central authority. It's governed by a decentralized network of computers, also known as nodes, spread across the globe. This means it's not subject to the monetary policies of any single government or entity. As such, it's immune to the effects of inflation caused by government actions such as quantitative easing, where more money is injected into the economy, often leading to inflation. Thirdly, Bitcoin's potential for high returns is another attractive feature for investors. Since its inception, Bitcoin has seen significant price appreciation, outperforming traditional asset classes. While past performance is not indicative of future results, the potential for high returns is an aspect that draws some investors to Bitcoin as a hedge against inflation. But how does Bitcoin stack up against traditional hedges like gold? Gold has been used as a hedge against inflation for centuries. Like Bitcoin, it has a limited supply and is not controlled by any government. However, while gold has a long track record of preserving wealth over time, it doesn't offer the potential for high returns like Bitcoin does. On the other hand, Bitcoin, with its digital nature and global accessibility, offers a level of liquidity and ease of transaction that gold cannot match. It can be bought, sold, and transferred with ease anywhere in the world at any time of the day. This is a significant advantage in an increasingly digital and globalized economy. However, it's important to note that while Bitcoin has these advantages, it's not without risks. Bitcoin's price is known to be extremely volatile. Its value can fluctuate wildly in a very short period of time, which can lead to significant losses. Investing in Bitcoin requires a good understanding of the market and a high risk tolerance. Moreover, while Bitcoin is independent of government control, it's not immune to regulatory risks. Governments around the world are still figuring out how to regulate cryptocurrencies, and changes in regulations can have a significant impact on Bitcoin's value. While Bitcoin has its advantages, it's not without risks. It's important to do your own research and consider your risk tolerance before investing. After all, the best investment strategy is one that aligns with your financial goals and risk tolerance. We've covered a lot of ground today. Let's wrap things up. In the course of our discussion, we dive deep into the concepts of inflation and Bitcoin. We explored how inflation, which is the general increase in prices and fall in the purchasing value of money, is a phenomenon that affects economies worldwide. We also took a look at Bitcoin, a decentralized digital currency without a central bank or single administrator that can be sent from user to user on the peer-to-peer Bitcoin network. We then connected the dots, examining how Bitcoin could potentially serve as a hedge against inflation. We discussed the idea that as fiat currencies lose their purchasing power due to inflation, assets like Bitcoin, with its capped supply and decentralized nature, can act as a store of value. However, as we've also seen, Bitcoin is not without its risks. Its highly volatile nature and susceptibility to market sentiment can lead to rapid price fluctuations, which can be a double-edged sword. Furthermore, the regulatory landscape for cryptocurrencies is still evolving, and changes in laws or policies can have significant impacts. It's important to remember that while Bitcoin has shown potential as a hedge against inflation, it's not a guaranteed safeguard. Like any investment, it involves a degree of risk, and it should be approached with caution and thorough research. So, is Bitcoin the best hedge against inflation? The answer isn't a simple yes or no. It depends on various factors, including your individual financial situation, risk tolerance, and investment goals. What's clear, though, is that Bitcoin has introduced a new paradigm in the financial world, and its potential and implications are worth exploring. Thank you for joining us in this exploration of Bitcoin and inflation. If you found this video helpful, please subscribe to our channel, like this video, and share it with others who might find it useful. We look forward to seeing you in our next video.